Hi, welcome to PSI, Plan, Save and Invest. Today I want to share more insights about the moving averages trading system, the simplest way to identify opportunities and manage the risk. This video is handy for positional traders investing in stocks for less than 1 year. If you are a trader who wants to hold stock for 2 months and 3 months and take advantage of 10% to 20% movement in a stock, then you are considered as a positional trader and this video will be helpful for you. It is also helpful for long-term investors and day traders, but depending on the use of right time frame of the chart and experience in the trading. I recommend not to use technical analysis on indices trading like derivatives trading, trading on futures and options, Nifty and Bank Nifty, because technical analysis is not suitable for highly volatile securities like indices, because indices are more sensitive to global events and many institutional players change their opinion instantly and the volumes are very high. So if you are a derivatives trader, better use derivative tools for trading derivative like open interest, put call ratio analysis, max pain, etc. I will explain these in my upcoming video. Coming back to our topic, pioneering moving averages with ADX. I will directly address the use case scenario of moving averages instead of explaining how to construct them. I will use the DLF daily chart to explain the use case scenario. I generally use 14-day exponential moving average as my fast moving average and 50-day exponential moving average as my slow moving average. But you might ask me like why 14 and 50? Generally a 10-day moving average on daily chart accounts for 2 weeks price action and 20-day moving average accounts for almost a month. However, the 14-day moving average balances short-term responsiveness and medium-term trend identification. The 50-day moving average acts as a crucial support and resistance for short-term, smoothing out short-term fluctuations. Why exponential moving average? This helps to avoid the dropout effect caused by the simple moving averages. Exponential moving averages gives more weight to recent prices without ignoring the older prices. So these are my reasons to consider exponential moving average, 14-day fast moving average and 50-day slow moving average. Most successful traders use fast moving averages for two reasons: to generate signals, buy signal and sell signal. And second, the fast moving average also helps as a trailing stop loss. Okay, the 50-day moving average, which is a slower one, acts as a support and resistance for the short term period. Okay, it's all good. Most of us know that whenever 14-day moving average crosses above 50-day, then it's a buy signal. And similarly, whenever 14-day moving averages crosses below 50-day, it is a sell signal. This is a known fact to everyone. But in real terms, most of the times the bigger challenge is signal failure. Most traders, particularly new traders, gets frustrated with signal failures. These are called whipsaws. Yes, the moving average system fails and gives unreliable signals when prices are in sideways market. But if the prices are trending, moving averages system can be highly useful to make more profits and also to manage your risk, like placing trailing stop loss and exiting the position at the right time, not at the extreme points. Nobody can exit, but at least you can exit at a right time using the trailing stop loss. But what is the solution to this whipsaws? How do we identify when the market is going to trend and when the market is going to trend in sideways? So this is a challenging thing. So one of the most preferred tools for identifying productive signals is using envelopes with average true range. So envelopes is another technical analytical tool. Most stockbrokers provide these two tools. One is envelopes and Other one is average true range. So let us use these tools and figure out like how can we filter productive signals which are generated by moving averages during trending markets and avoid trading during sideways market, the signals generated by moving averages system. So the first step what I do here is I'll just simply add average true range to figure out the percentage average range the stock price is moving. So there are two tools here. One is average true range and another one is average true range percentage. So I directly take average true range percentage. So here it shows me approximately 3.18 percentage. This is very highly volatile stock because 3.18% is an average true range. Sometimes it is as high as 4% and 5%. In case if you are in conservative trader, better you take the highest average true range. But if you are a moderate risk taker, then you can consider the latest average true range. In case if your stockbroker is not providing the percentage terms, then don't forget to add average true range itself and convert it into percentage. So suppose like if you take the average true range is approximately 26 as per the recent highs. Okay, then what you can do is like you can open your calculator, do 26 divided by latest stock price, that is 794 approximately. So it comes into 100, you do it is approximately 3.3%. So I'll take 3.3% as the average true range of this stock, that is DLF. So now I'll start constructing the envelopes and moving averages system. The first thing what I did is I added average true range to figure out the percentage. Now I figure out the percentage, that is approximately 3.3 percentage. So what I do is I'll directly go add envelopes. I'll click on indicator and I'll type envelope. So envelope is available here. By default values it gets added on the chart. Now we'll do the changes to this default values. What I do is like inputs. So my fast moving average is 14 and slower moving average is 50. So I'll take 50 here. The percentage, not 10%, I will consider 3.3%. And then I consider exponential, not a simple moving average, to eliminate the dropout effects. And I'll change the basic colors and identifications. Yep, now my envelope is ready. On this envelope what I do is I will again add in another tool called exponential moving average. By default 9 moving average gets added, so I just do changes like 14, so 14 and then it's an exponential. Yes, I will generally use this color. Yeah, so my moving average trading system with filters, the filter is envelopes, both are added. So the thumb rule is whenever 14-day moving average crosses above 50-day moving average, it's a buy signal. And whenever the 14-day moving average crosses below the 50-day moving average, it's a sell signal. But the problem is there will be number of failure signals. You can see on the DLF from the period of March 2024, consider March 2024, around April, May 2024 to December 2024, almost like almost like 10 months the stock is in a sideways and it generated many signals. Here one signal, this is a failure signal. Again here one buy signal which is failed. These all are called VIPHAMs. So these gets generated during sideways markets. When the prices are not trending, and if the moving average system gives a signal, then definitely you should consider it as a failure signal and you should not take the opportunity to trade in the sideways market using moving averages trading system. Now you see how beautifully it got filtered, the whip hands. So now the thumb rule is changed. We added an envelope. So whenever 14-day moving average crosses 50-day and the upper envelope, then it is a buy signal. So here you can see it crossed the 14-day moving average crossed both 50-day as well as 14-day upper envelope, the band. Then you can see you would have captured this price movement. And every time, you can put a stop loss whenever the price moves away from 50-day moving average and 40-day moving average. You can keep trailing the stop loss. You can just place a stop loss below 14-day moving average and you can keep following the trend up till here. And probably if you would have placed the trailing stop loss below 14-day moving average, that would have triggered here, but not an issue for you because you would have captured almost 40 to 50% movement. It's a good moment. That's the ideal way to trade. That is the advantage what positional traders will have. Intraday you can use, but that has its own risk because the VPAMs will be higher and the fluctuation will be higher. So yeah, for the positional traders, with a decent amount of stop loss and risk management, you can capture good amount of profits using trading moving averages system. Now again, once the stop loss is triggered here, you can see here the prices slowly dropping, and this is a sell signal, but it failed to cross lower band, so it is not a proper sell signal. You can consider the prices went into sideways. Again here it a buy signal, but it failed to cross the upper band, so again the filter acted beautifully. Again it's a sell signal here. The 14-day moving average failed to cross the lower filter, so it is not a sell signal. Here again this signals, all these bad signals and unreliable signals in the sideways are beautifully filtered by the bands. As I said, like if you want to be more conservative, you can take 4%, 3.5% based on your convenience. Now here the 14-day crossed the signal, I'm sorry, lower band. So but the duration is very short. Again the prices started trending. Again this is a fail signal. The filter filtered that don't buy because the 14-day moving average didn't cross it above the upper envelope band. So forget about that. Again 14-day cross below the 50-day, it is a sell signal. In case if you want to hold a put or something, once the 14-day moving average crossed below the lower band, you can consider it as a bearish signal, and you can see you can capture all this movement beautifully. And once again, now currently the 14-day moving average crossed both 50-day moving average and the upper envelope band, giving a buy signal with volumes, with above average volumes. So you can see here a price trends with the volume, so the volumes are higher. So you can take an advantage of buying here and placing a trailing stop loss below 14-day moving average. So in case if I place the stop loss around 730 and if I purchased at 794, in case if we purchase today at 794, 794 minus 730 below the 14-day moving average, that is 64 points divided by 794. So approximately I am risking 8%. So 10 to 8% is a general risk you can consider. Suppose if I'm investing 1 lakh rupees today in DLF at 794, I will purchase at 794 and I will place a stop loss at around 730 below my foot in the moving average here. So what I do is like, I'll wait till the price action to happen in my favor. So whenever the price action is happening, I'll keep moving my stop loss trailing. I'll keep trailing the stop loss till the prices trends in the direction. So this is the advantage of using envelopes. So it will filter you the bad signals generated by moving average system during the sideways market, and it will give you only the productive signals when the prices are trending. So you can if you have any doubts, you can you can look at the previously also. So here one signal came, and there is a chance that you can capture at least 10%. And there are signals where like you can, so it basically filters the bad signals. And every time whenever there is a signal along with the crossover happening either of the band, look for the volumes. If the volumes are rising, and also check if there is any fundamental news. If there is any fundamental news, then that also add, like every technical analysis should be supported by a fundamental facts. So there is like reality check, that um, brokerages has upgraded DLF targets. So that one good scenario, like an ICICI Securities changed its upgraded its target to somewhere 984. But all these are subjected to the personal analysis. I primarily want to focus on trading system. So the if you have a strong trading system, that will help you to keep you strong in your analysis and making profits. So now what is the use of ADX? Now I'll add one more indicator. Directional momentum index. For more visibility, what I'll do is just do small settings. Both moving averages and ADX are lagging indicators. But what happens is, like, one advantage of ADX directional momentum index is it can give you early signal for reversals. Like suppose if you let's take one long-term trend. Okay, so here you can observe that blue line crossed red line, it's a buy signal. So here similarly you can see there is envelope like a 14-day moving average maintained the bull trend happening. So what happens is, like if you see here the signal came, but here ADX clearly upfront it told that there is a small reversal happening here. So how ADX can help your trading is, in case if the price action, like if you see like in the during the long bull trend, you can see there is small fluctuation here. It can identify there will be a small fluctuation. It doesn't mean it is complete trend reversal. You can but you can become conscious, and then you can take the step forward for waiting for few days. What happens is, like ADX will give you like upfront, will make you conscious like when the trend is going to reverse. One other beautiful aspect of ADX is like these are DI positive and this is DI negative. This is the red line is ADX. Whenever there is a red line is like like at peaks, you can consider there, there will be some short term corrections in the prices. So that one advantage is there. And when this ADX, the red line, is rising, not falling, when if it is falling, when it is the ADX rises even in the uptrend or downtrend, like the ADX shows only the strength of the trend. It could be bull or bear. So if the ADX is rising and if the trend is up, then you can consider the trend is going to be a strong trend. And in case if the prices are falling, and and if ADX is raising, then this downtrend is strong. So this is how you can use ADX and moving average trading system, to help your trade. When to exit, I already told you. If you're able to capture one good trend, then you can use your fast moving average as a reference for trailing stop loss. Place your trailing stop loss below fast moving average and try to take advantage as much as possible. So that's all about this video. I hope you enjoyed the video. If you liked our content, please do like, share, subscribe, and give your feedback in the comment section. And in case if you have any more analytical tools or like an analysis, please feel free to comment. So we do improvements in our upcoming videos. Thank you so much.